What would you do if you woke up tomorrow and discovered your bank account was frozen? No ATM access, no transfers, no way to pay your bills. It sounds like something from a disaster movie, but for millions of people around the world, this has already happened. And here's what most people don't realize. The assets we're taught to trust would become completely worthless during a bank collapse. Today, I'm going to reveal 7 specific assets that fail when the financial system breaks down. I guarantee some of these will surprise you, because they're the exact things financial advisors tell you are safe. By the end of this video, you'll understand why these assets crumble and what you should be thinking about instead. I help people understand money, personal finance, and building wealth. If you're interested in protecting your finances and making smarter decisions with your money, make sure to subscribe to the channel and hit the like button if this information helps you out. Before we dive into these 7 assets, let me ask you something. When you think about a bank collapse, what actually comes to mind? Do you picture long lines outside banks with people desperately trying to withdraw cash? Or do you imagine it's something that only happens in far-off countries with unstable governments? The truth is, most of us have no idea what a banking crisis actually looks like until it's too late. And here's the thing that makes this whole topic so important. Bank collapses have happened in developed nations more recently than most people realize. In 2013, Cyprus experienced a banking crisis that shocked the world. In 2001, Argentina's financial system collapsed so completely that citizens couldn't access their own accounts for nearly a year. In 2015, Greece imposed capital controls limiting ATM withdrawals to just €60 per day. These aren't ancient history. These are events that happened to regular people who thought their money was safe. Now, when I say an asset becomes worth nothing during a bank collapse, I don't necessarily mean it goes to zero on paper. What I mean is that it becomes inaccessible, frozen, or so rapidly devalued that it can't serve its purpose when you need it most. Think about it this way. If you have $100,000 in an account but you can't withdraw a single dollar to buy groceries, what is that money actually worth to you in that moment? Nothing. Understanding which assets fail isn't about being a doomsday prepper or assuming the worst will definitely happen. It's about recognizing the hidden risks in things we've been told are completely safe. Once you see these vulnerabilities, you can make more informed decisions about how to protect yourself. So we're going to go through 7 specific assets that most people trust with their financial future. And I'll give you real historical examples of what happened to people who were counting on them. Let's start with an asset that almost everyone assumes is completely safe. Let's start with the most obvious one, the money sitting in your bank account right now. This is supposed to be the safest place for your money, right? You deposit your paycheck, the bank holds it for you, and it's there whenever you need it. That's how it's supposed to work. But here's the thing most people don't understand. When you deposit money in a bank, it's not really your money anymore. Legally, it becomes the bank's money, and what you have is essentially an IOU. The bank promises to give you that money back when you ask for it. Under normal circumstances, that works perfectly fine. But during a banking crisis, that promise can evaporate overnight. Let me break that down with a real example. In March 2013, the government of Cyprus made a decision that most people thought was impossible in a modern democracy. They took money directly from depositors' accounts. Anyone with more than €100,000 lost 47.5% of their funds. Not invested in risky stocks, not gambled away, just sitting in what they thought was a safe bank account. 47.5% gone overnight. And here's the kicker. The people who lost this money didn't do anything wrong. They were business owners, retirees, ordinary citizens who had simply saved their money. They woke up one morning and nearly half of their life savings had been confiscated to bail out the banking system. Now, you might be thinking that couldn't happen in America because we have FDIC insurance. The FDIC insures deposits up to $250,000 per depositor per bank. That sounds reassuring until you consider what happens in a systemic crisis. The FDIC has about $120 billion in its insurance fund. There are over $10 trillion in insured deposits. If multiple major banks failed simultaneously, that fund would be wiped out almost immediately. But even if the FDIC worked perfectly, there's another problem. During a banking crisis, your money gets frozen. In Argentina in 2001, the government imposed what they called the corralito. People could only withdraw 250 pesos per week from their accounts. Their money was there on paper, but they couldn't touch it. Bills went unpaid. Businesses couldn't make payroll. People couldn't buy medicine or groceries. Think about that for a second. Could you survive on $250 a week if you couldn't access any of your other funds? And that lasted for almost a year. This is what financial experts call counterparty risk. Your bank account only works if the bank works. When the bank fails, your access fails with it. But bank deposits are just the beginning. Let's talk about something that millions of Americans rely on every single day for their financial future. Now, you might be thinking your situation is different. You're not keeping all your money in a savings account earning nothing. You've been smart. You've invested in your 401k, your IRA. Maybe you have a brokerage account with stocks and index funds. Your money is working for you in the market, not just sitting in some bank vault. That's actually not as safe as you think. Let's talk about retirement accounts first. Your 401k and IRA might feel like they're separate from the banking system, but they're deeply connected to it in ways most people never consider. The funds in your retirement account are held by custodians, often large financial institutions that face the same problems as banks during a crisis. But here's what really gets me about retirement accounts. In 2008, Argentina did something that most Americans would consider unthinkable. The government nationalized private pension funds, taking nearly $30 billion from citizens' retirement accounts and moving it into the state-run system. $30 billion confiscated. Think about that for a second. Could something like that happen elsewhere? During the Greek debt crisis, the government forced pension funds to invest in Greek government bonds. Those bonds later lost about 75% of their value. Retirees who thought their pensions were secure watched their retirement income collapse because the government needed their money. And even in America, retirement accounts have a built-in trap. If you need to access your 401k before age 59 and a half, you face a 10% penalty plus income taxes. During a financial crisis, when you desperately need cash, a huge chunk disappears to taxes and penalties just when you need it most. Now, let's talk about your brokerage account and the stocks you own. You might assume that because stocks represent ownership in real companies, they're somehow safer than cash in a bank. But during a banking crisis, the stock market becomes a trap of its own. Here's something most people don't know. The New York Stock Exchange has been closed for extended periods multiple times throughout history. In 1914, at the outbreak of World War I, the NYSE closed for 4 months. 4 months where investors couldn't sell a single share even if they desperately needed the money. And here's the kicker. When Lehman Brothers collapsed in 2008, customers with accounts at the firm couldn't access their money for months while everything was sorted out in bankruptcy court. Their stocks existed on paper, but they couldn't touch them. More recently, trading halts through circuit breakers can freeze the market precisely when you most need to sell. So we've covered cash, retirement accounts, and stocks. But surely there are some assets that hold their value no matter what happens, right? Let's talk about that. You've probably heard that during a crisis, you should move into bonds. Flight to safety, right? When stocks are crashing and banks are failing, government bonds are supposed to be the one thing you can count on. The full faith and credit of the government backing your investment. Here's the problem with that logic. Government bonds are only as safe as the government issuing them. And during a banking crisis, government finances often deteriorate rapidly as they bail out banks and try to stimulate the economy. When Greece restructured its debt in 2012, private bondholders lost about 75% of the face value of their bonds. These weren't junk bonds from some fly-by-night company. These were bonds issued by a member of the European Union. 75%. 3/4 of their investment, gone. Corporate bonds are even riskier. Companies that depend on credit to operate can fail rapidly when banks stop lending. When a company goes bankrupt, bondholders often recover pennies on the dollar, if they recover anything at all. But here's what really makes bonds dangerous during a crisis: interest rates. When central banks respond to financial turmoil by changing rates, the value of existing bonds can swing wildly. If you bought a bond paying 2% and rates suddenly jump to 5%, your bond becomes worth significantly less. And during a crisis, selling that bond at a fair price might be nearly impossible. The paradox of bonds as a safe haven is that they're often issued by the same entities causing or suffering from the crisis. Does that sound safe to you? Now let's talk about something financial advisors often recommend for long-term protection: cash value life insurance. Whole life policies, universal life, those products that promise to build value over time while providing death benefits. The pitch sounds great. Your money grows tax-deferred, protected from market volatility, and you can borrow against it if you need cash. But here's what most people don't realize. Life insurance companies invest your premiums in the same financial system that's collapsing. Insurers are major holders of corporate bonds, mortgage-backed securities, and yes, bank deposits. In 2008, AIG, one of the largest insurance companies in the world, required a $182 billion government bailout to avoid collapse. $182 billion. If the government hadn't stepped in, millions of policyholders would have faced uncertainty about whether their claims would ever be paid. And even if your insurance company survives, cash value policies have surrender charges that make accessing your money expensive and slow. That policy designed to protect you becomes another trap. At this point, you might be starting to feel like nothing is safe. And honestly, we're not done yet. Let's talk about the assets that most preppers and financial planners recommend. Okay, so you might be thinking you've figured this out. Bank accounts get frozen, retirement accounts can be seized, stocks can be halted, bonds can default, insurance companies can fail. The obvious solution is to keep physical cash at home. Just stuff a bunch of hundreds under your mattress or in a safe, and you'll always have access to money when you need it. But here's where it gets really interesting. Physical cash has its own set of vulnerabilities that most people never consider. And when banking systems collapse, those vulnerabilities can become catastrophic. In November 2016, the Indian government made an announcement that shocked 1.3 billion people. Prime Minister Modi declared that all 501,000 rupee notes, which represented 86% of all currency in circulation, would become invalid. 4 hours. That's all the warning they got. Within 4 hours, those bills could only be exchanged at banks under strict limits. People who had saved cash at home suddenly found the majority of their savings was essentially worthless unless they could prove where it came from and pay taxes on it. Lines at banks stretched for hours. Some elderly citizens collapsed and died waiting to exchange their life savings. Now, you might think that can't happen in America. We wouldn't just invalidate our own currency overnight. But here's the thing. Currency demonetization has happened throughout history in many different countries. And even without demonetization, physical cash has a more insidious vulnerability. Inflation. When banking systems collapse, governments typically respond by printing money. That money printing can trigger rapid inflation that destroys the purchasing power of every dollar you've saved. In Venezuela, inflation reached over 1,000,000% in 2018. $1,000 in cash became worth less than a penny in purchasing power within a few years. Think about it this way. If you have $10,000 hidden in your house and inflation hits 50%, that money can only buy what $5,000 could buy before. You didn't spend a dime, but half your savings evaporated anyway. And here's the kicker. During severe financial crises, governments have sometimes made large cash holdings illegal or imposed reporting requirements that effectively criminalize keeping significant amounts of physical currency. The cash you kept to protect yourself can become evidence of tax evasion or hoarding. There's an old saying in finance that cash is king. But that's only true if the kingdom still exists. When the monetary system itself is in crisis, even the cash in your pocket can become worthless paper. So if cash, bank accounts, stocks, bonds, retirement accounts, and insurance all fail during a bank collapse, what about the one asset everyone says is the ultimate hedge? Let's talk about that. This brings us to gold. The ultimate crisis hedge, right? For thousands of years, gold has been used as money. It survives wars, revolutions, and economic collapses. When everything else fails, gold endures. But here's a crucial distinction most people miss. There's a massive difference between physical gold you can hold in your hand and paper gold, which includes ETFs, futures contracts, and allocated gold accounts. That difference becomes critical during a banking crisis. Let's start with gold ETFs like GLD and IAU. These are funds that supposedly hold physical gold on your behalf. You buy shares, and each share represents a fraction of an ounce of gold stored in a vault somewhere. Sounds great in theory, but think about what you actually own. You don't own gold. You own shares in a fund. Those shares are held through a brokerage account, which we already established can be frozen. The fund itself is managed by financial institutions facing the same problems as banks, and the actual gold is held by custodians who may have their own issues. During a severe crisis, there's no guarantee you can convert those paper shares into physical gold. The fund might halt redemptions. Trading might be suspended. You could own shares representing millions of dollars worth of gold and have no way to access any of it. Gold futures contracts are even more problematic. These are agreements to buy or sell gold at a future date. But here's the kicker. Futures exchanges have the right to force cash settlement instead of physical delivery. Even if you want the actual gold, the exchange can decide to just give you dollars instead, and those dollars might be worth far less than the gold you were expecting. Even allocated gold accounts can be problematic. Some of this gold may be rehypothecated, meaning it's been pledged as collateral for other transactions. When the system is under stress, multiple parties might have claims on the same gold. And here's something most Americans don't know. In 1933, Executive Order 6102 made it illegal for U.S. citizens to own more than a small amount of gold. People were required to turn in their gold to the Federal Reserve. This lasted until 1974. Could something like that happen again? History suggests we can't rule it out. Here's the thing that really gets me about all 7 of these assets. They all share one fatal flaw. They all depend on institutions continuing to function normally. Your bank account requires the bank. Your retirement account requires the custodian. Your stocks require the exchange. Your bonds require the issuer. Your cash requires the government. Your paper gold requires the fund, the exchange, and the custodian. When those institutions fail, your access fails with them. Okay, I know what you're thinking. If all of these assets fail during a bank collapse, is there anything that actually survives? The good news is yes, there is. But here's the good news. And this is why I wanted to share all of this with you. Once you understand what fails during a banking crisis, it becomes pretty clear what actually survives. And the common thread is simpler than you might think. Assets that survive are assets you physically control with no counterparty risk. Let me break that down. Physical precious metals that you hold in your own possession, not in a bank safe deposit box, not in a vault managed by someone else, but actually in your hands. When Cyprus froze bank accounts, people who had physical gold and silver coins at home could still buy groceries. When Argentina imposed the corralito, those with physical metals had purchasing power while their neighbors waited in line at banks. You don't need a vault full of gold bars. Even a modest amount, a few $1,000s in silver coins or small gold pieces, gives you options when paper assets become inaccessible. Real estate is another asset that can survive, but with important caveats. Productive property that you own outright, meaning no mortgage, provides both shelter and potential income. During the Great Depression, people who owned their farms and homes outright had somewhere to live and could grow food or rent space. But here's the catch. If you have a mortgage and the banking system collapses, your lender might still expect payment. Debt-free ownership is what matters. Skills and knowledge are assets that can never be frozen or seized. If you can fix cars, grow food, provide medical care, repair electronics, or offer any other valuable service, you have something to trade regardless of what happens to the financial system. During every crisis in history, skilled tradespeople continued earning through barter and direct payment. Strong community relationships matter more than most people realize. During Argentina's crisis, neighborhoods organized to share resources and protect each other. Those with strong social networks weathered the storm far better than isolated individuals with more money but fewer connections. Think about it this way. You don't need to become a doomsday prepper living off the grid to protect yourself. Small, practical steps can make an enormous difference. Keep some physical cash outside the banking system, but also some physical precious metals. Develop skills that have value regardless of what happens. Build relationships you can count on. Pay down debt to reduce your dependence on institutions. The compound effect of these small steps is significant. Each one reduces your counterparty risk by a little bit, and together they provide meaningful protection without requiring you to change your entire life. The beauty is that these preparations cost very little if nothing bad ever happens, but if something does go wrong, they could make all the difference. The bottom line is this. These 7 assets that failed during a bank collapse should be eye-opening, but they should also be empowering. When you know what most people don't know, you can make different choices than most people make. And here's what I find most interesting about everything we've discussed. There's a massive gap between what people assume about financial security and what actually happens during a crisis. Most people believe their bank accounts are safe. They believe their retirement funds are untouchable. They believe bonds are conservative and cash is king. They believe these things because that's what they've been told their entire lives. But history tells a different story. Cyprus, Argentina, Greece, Venezuela, India. Real countries with real people who lost real money because they trusted assets that failed when they needed them most. These aren't hypothetical scenarios. They're documented events that happened within the last 25 years. If you're watching this video, and some of these examples hit a little too close to home, don't panic. The fact that you're here, learning about these vulnerabilities and thinking about how to protect yourself, already puts you ahead of most people. The average person never considers what would happen if the banking system failed. They assume it can't happen. Or if it does, the government will fix everything. Maybe they're right. Maybe nothing bad will ever happen. But personally, I'd rather have some insurance and not need it than need it and not have it. You don't need to liquidate your retirement accounts or stuff your mattress with gold bars. That would be an overreaction. What you need is awareness and balance. Keep most of your assets in traditional investments if that makes sense for your situation, but recognize they come with counterparty risk. Then take small, practical steps to reduce that risk. What I really want you to take away from this isn't fear. It's understanding. When you understand how the financial system actually works, including its vulnerabilities, you can make informed decisions about how much risk you're comfortable with. You deserve better than having your entire financial future depend on institutions you can't control. You deserve better than assuming everything will always work the way it's supposed to. You deserve better than learning these lessons the hard way, like millions of people in Cyprus and Argentina and Greece already have. You deserve the peace of mind that comes from knowing you've taken reasonable steps to protect yourself and your family. These 7 assets show us where the average person's assumptions fail. But they don't have to define where you end up. Use them as a starting point for thinking differently about financial security, not as a reason to panic. The choice is yours.